Welcome. This is an XFO Intelligence Briefing. Our topic for January 2026, it's the profound transformation of the global monetary architecture. For over half a century, the narrative has been defined by a single protagonist, the US dollar. But our analysis, conducted with deep augmented thinking, reveals that we are now moving beyond dollar hegemony. Now, the global monetary system is not headed for a sudden cataclysmic collapse. No, nor is the dollar's dominance perpetual. We are navigating a managed, if, occasionally turbulent transition to a multipolar monetary system. This is a story of gradual fragmentation, and it's driven by the powerful convergence of geopolitical realignment, institutional stress, and, of course, technological disruption. Let's begin with the current state of play, which is, it's a picture of stark contrast. On the surface, the dollar's transactional power is undeniable. It still facilitates 88% of all global foreign exchange. It denominates over half of all global loans and trade invoices. Its network effects and deep liquidity, they create this powerful inertia, a gravitational pull that is, frankly, difficult to escape. However, beneath these formidable metrics, the foundational pillars are cracking. The first vulnerability is the erosion of institutional credibility, the systematic politicization of central banking, and this is critical, the assault on the independence of the Federal Reserve. That is a fundamental threat. Global trust in the dollar is predicated on the belief in predictable, rule-based policy. It takes decades to build that credibility. It can be destroyed in a matter of weeks. Second, there are severe debt sustainability concerns. The United States' net international investment position has reached an unprecedented negative 90% of its GDP. To put that in perspective, this single nation's international debt is equivalent to 1/4 of the entire global GDP. This is a structural risk of historic proportions. This leads to a critical disconnect we are now observing in financial markets, a divergence between the demand for dollars for transactions and the demand for dollar-denominated debt as a store of value. The convenience yield on U.S. Treasuries is declining. The market is signaling it's beginning to treat the dollar as a necessary utility, but not as a trusted repository of wealth. So, what is driving this fundamental shift? We have identified three primary drivers. First, a geopolitical reckoning. The weaponization of the dollar-based financial infrastructure for sanctions, for coercion, has triggered a powerful, defensive diversification. The Greenland incident was a watershed moment, accelerating European determination to achieve monetary independence. As one panelist at Davos observed, "I've never seen the Europeans so angry, so apoplectic." This defensive posture, it extends beyond just sanctions to concerns over financial surveillance and data sovereignty. For sovereign wealth funds, for central banks, dollar dependency is no longer just an economic calculation, it's a strategic vulnerability. The second driver is what we term civilizational monetary preferences. Different global civilizations, you see, they express distinct values in how they believe money should be governed. The Western model emphasizes institutional independence, market efficiency. The Chinese approach prioritizes monetary sovereignty and coordination with developmental goals. The European perspective focuses on regulatory power, data protection standards. Thoughtfully, these are not merely technical differences, they reflect deep-seated philosophies about the relationship between the state, the market, and the individual. The third driver? Technological disruption. Digital currencies, alternative payment systems, they're evolving faster than any coherent governance framework can manage them. And, critically, payment infrastructure development is proceeding faster than currency substitution. The development of independent transaction rails, like the mBridge project connecting China and ASEAN nations, that may prove more significant in the long run than shifts in reserve currency holdings. They determine who sets the standards for the next generation of finance. So this leads to the crucial question of what comes next. Our analysis indicates the most probable pathway is a scenario of gradual fragmentation. Central bank diversification will continue, shifting towards dollar-like currencies from stable middle-power economies. Regional currency blocks will consolidate. You'll see dollar dominance in the Americas, euro consolidation in Europe and Africa, and the yuan anchoring Asia. The cost will be what we call a fragmentation tax, a projected 15 to 20% increase in global transaction costs, which could reduce world GDP growth by over a percentage point annually. But this fragmentation need not be chaotic. The optimal pathway is not the replacement of one hegemon with another, but the development of a layered civilizational respect framework. Imagine an architecture in 4 layers. At the bottom, a shared infrastructure layer, multiple interoperable payment systems, common technical standards, all operating as a global commons. Above that, a value coordination layer with hybrid backing mechanisms to ensure stability. Then, a policy implementation layer, distinct zones reflecting different monetary philosophies, a developmental sovereignty zone, a market coordination zone, and an ethical finance zone. And at the very top, a cultural identity layer, where currency design and financial education reflect the diverse values of the civilizations they serve. So for Western nations, the strategic imperative is clear: rebuild institutional credibility and address unsustainable debt. For China and emerging powers, the challenge is to balance state guidance with market efficiency while building trust through transparency. The evidence is conclusive. Dollar hegemony is in its terminal phase, ending not with a bang, but through the accelerating erosion of its foundations. The future will not be a single hegemon, but a more complex, layered, and living monetary ecosystem. This ecosystem will be less efficient by today's metrics, yet it will be dramatically more resilient. The trade-off, accepting a modest tax on efficiency to preserve civilizational values and reduce catastrophic systemic risk, is one we must be prepared to make. The civilizations that thrive in this new era will be those that see monetary systems not as tools of dominance, but as bridges of shared prosperity. Now, here's a question we'd like you to think about. As this transition unfolds, which trade-off is more critical for our shared future? The transactional efficiency offered by a single dominant system, or the systemic resilience promised by a diverse, multipolar one?